Thank you, Michael, and good afternoon, everyone. My name is Todd London. I'm the Senior Vice President of Sales and Marketing for Sherwood Lumber, and I appreciate everyone taking some time to sit down with us today and talk about navigating this market. So risk management and forward pricing is a large part of what Sherwood Lumber does, and we're excited today to discuss with you our take on kind of how you can protect yourself and maximize some of your profits along the way. And hopefully through this provide you some value both today and the rest of this year, which appears to potentially be fraught with some deal of volatility. So a bit of housekeeping for everybody. At this time, if you're not already, I'd like to ask that you take some time to mute your computers. The mute button can be found in the lower left-hand corner of your computer. We do, however, plan on making this presentation conversational. And the way that we're going to do that is by using the chat feature. So for those of you who aren't familiar with Zoom at this point, the chat feature can be found in the bottom center part of your screen. If you have a question at any point during the presentation, go ahead and throw your question in that chat feature. And a moderator on the Sherwood line will acknowledge that they've seen your question, and they're going to make our speakers aware offline that some questions are being asked so that our speakers can stop at the most rational and logical point so they can crescendo their point and also address the question in the moment of the topic. So we're going to use that chat feature. If you're listening and you're someone that wants to participate, show us a little chat right now just so we can see it's working for you. And that's how we're going to handle making this as conversational and as value added to you as we possibly can. Okay, so with that and without further ado, I'm very happy to introduce to you our speakers. We have two speakers who will be talking to us today. The first is our COO, Kyle Little, and the second is our Director of Risk Management and Forward Pricing, Steve Loebner. And so with that, Kyle, Steve, the floor is yours.
Well, thank you, Todd. I just got myself off mute, so got that lower left-hand quadrant figured out now. Thank you for your help. Just want to welcome everybody to our webinar today. We've had a few of these in the past, really talking about introductory, a little bit of what goes on in regard to forward pricing and what have you. We're going to take a little bit more in-depth approach today and really open it up to some question and answer to the group and what have you, but to go over general philosophy and then ultimately, what we've experienced over the last 6 to 12 months and what we expect to experience over the next 6 to 12 as well. So welcome everybody. Again, my name's Kyle Little. I'm the Chief Operating Officer at Sherwood Lumber. I've been here for almost 12 years now and started in a variety of different roles, mostly in the trading environment and then into the risk management and now in a little bit more of an executive management as well as still trading and working with Mr. Loebner, our forward pricing expert and going out and managing the volatile times that we have. So Steve, I will pass the baton over to you to kind of take us away. Thank you so much.
You bet. Thanks, Kyle. First of all, appreciate everyone jumping on the phone. Looking forward to today. I think this is maybe our fourth or fifth forward pricing webinar. We definitely have the highest interest ever on this call. Obviously, it's no surprise, given the crazy times we're going through. But brief introduction of myself. I work in our Portland, Oregon office out here. As Kyle mentioned, I run the risk management and forward pricing for Sherwood Lumber across the nation. We have a 9-person trading floor out here. And I run that as well, in addition to buying and selling every day and, talking to mills and customers. So, we're doing a lot, keeping busy. Briefly, my background out of school, I was an options trader. I was on the Pacific Stock Exchange for a number of years, and then the Chicago Board Options Exchange for a few years prior to coming over to the lumber business. Started the industry at Block Lumber, which was in Chicago and was a real forefront in futures and derivative trading at that time. So that kind of meshed well with my background. And so here I am. I've been running the forward pricing book for a number of years, and it's, been a lot of fun, but also pretty crazy. We're going to talk about some of that stuff today of, how we can kind of navigate stuff going forward. Kyle, do you want to do the Sherwood stats here?
Yeah, just to kind of give everybody, I'm sure most of the people on the call know who we are, but if you don't, we'll just give you a quick overview. At Sherwood Lumber, we're a family-owned and operated business. We've been in operation for over almost 70 years now. We have 95 employees across the country. We're headquartered in the center part of Long Island in Melville, New York. We are primarily a commodity and forest products and a building materials distributor. 95% of what we do is commodity lumber and forest products, and then 5% exterior specialty products. Those numbers are kind of moving along as we speak. Projected volume in 2021, we'll do over 800 million board feet or square feet. Of that, 3/4 or almost 3/4 of that is something that we would physically touch in our distribution network. The other 30% would be delivered on a drop ship basis or direct ship basis directly from a manufacturer or vendor. We sold in over 45 states in 2019 and 2020. We have eight plus regionally dedicated distribution centers across the United States. And we have served over 2,000 customers in 2020, approximately 700 per month to over 6,000 different ship-to points across the country. So, in the three major categories of, talk about we'll be there, our tagline, we'll be there as a distributor, a risk manager, and a broker. That's who we are and what we pride ourselves in doing, the three major categories. Back to you, Steve.
Cool. So just a brief schedule of what we're going to do today. First half is going to be sort of the nuts and bolts basics. Why do we want to hedge? We're going to talk about our philosophy, because before you embark on this route of using these different hedging tools, it really is a little bit different than what a lot of people have been doing for a while. So we want to make sure we're kind of talking about the things that guide us as we make these decisions going forward and looking at the right metrics. Talk briefly about the hedging tools, although I'm going to assume a pretty high level of knowledge among this crowd about what about what all these things are. We're going to talk about things we need to think about just so that we get the most out of hedging, and we're doing it in a way that makes the most sense and the most impactful. And then Kyle's going to lead a little conversation in the back half of the presentation, talking about current market, where we're at, and some of the things that we're looking to potentially happen here going forward. And then we'll open up to questions. And of course, questions along the way, make sure and send them in that chat box, and we'll try to address them at the most appropriate time. Okay, why hedge? So I love this quote at the top. It's from this like super cheesy 80s movie, Big Trouble in Little China. But it's he goes, "I'm a reasonable guy, but I've just experienced some very unreasonable things." And I think we can all relate to that. I think that's why there's so many people on the call, is we really truly are, living through some unprecedented, crazy times. I mean, we all said in 2018, man, we'll never see this again. This was once in a lifetime. Then we had it happen in 2020, both on the downside and the upside. And now, of course, it's looking like we're going to have some craziness in 21. So just a lot of crazy stuff going on. Paul Tudor Jones here is a big hedge fund trader, and he said that at the end of the day, the most important thing is how good you all are at controlling your risk. 90% of any great trader is risk control. I think that's really, really important. We all look great when the winds at our back and we got some smooth waters and it's easy sailing. But when things get crazy, I mean, that's what separates the winning strategies from the losing. And so I think it's just really important to, this current market has really borne that out. So that's what we're talking about today, is risk control. So we want to hedge to reduce our risk, obviously. I mean, that's kind of a no-brainer. We want to have a little bit more predictability and reduce volatility. I mean, with the size of the players in the industry now, there's these swings. I don't have to tell you guys this. The swings in the market are just enormously impactful to the bottom line, both positive and negative. And we want to reduce that volatility, smooth out that curve so that we can do more profitable business and also, hopefully be able to sleep at night. So hedging is going to allow us to lock in profits. It's going to allow us to do more business overall, because if we don't have as much exposure and we know that our money isn't at risk as much, we can go and get, that much more business. Cash flow advantages is something that I don't think is fully appreciated in the risk management, in this space. Traditionally, a lot of models, basically we manage our risk by carrying physical inventory. So we'll use a multifamily, jobber, for example. If they have a lot of business coming up, it's 4 months out, the market we think is bottomed, we're going to put in 50 cars and sit on them for 4, 5, 6 months. That's how we protected ourselves. And it works, except it ties up enormous capital. You have to write a check for 50 cars at at $100,000 a pop or $120,000 a pop. That's a lot of money. Using some of these forward pricing and risk management tools, you can effectively cover that risk in the same way, while at the same time, with an absolute minimum of cash outlay. In some cases, no cash outlay up front, which would be the case with forward pricing. So it's enormously valuable when you translate that to hundreds of millions of board feet. The course of a year, that's huge. So that's a big deal. Lastly, if you run this hedging program properly, you should not only reduce your volatility, but enhance your overall P&L over the long run if you do it right. Okay, so before we go down this road, we have to have kind of a philosophy that guides us of what we're doing. We don't want to be just kind of willy-nilly doing stuff. We want to really incorporate hedging into our overall picture so that everything works together. These are the premises that we go off of to start. Number one, which is kind of surprising, coming from big futures traders, is we don't think that anyone can consistently outguess the market months and months down the road. I think most of us on the call are probably very good at the short run. We're probably pretty decent at the intermediate run. But the reality is, crazy stuff, black swans, whatever you want to call them, things change. There's just no way to predict. If I had asked everyone, even myself a year and a half ago, would we experience, what we experienced in 2020? No one would have said anything even close to what we've had. So crazy things happen in lumber and everything else. And we, I think once we recognize that we really don't know, then we can open ourselves up to analyzing the different things that can happen to us and how to lay that risk off, given all the different, potential eventualities of what could happen. So that's important. That's number one. It's not day trading. It's not market speculation. There's a speculative element to everything we do. There's certainly a little bit of a speculative element to the timing of when we put these things on, these trades on. And so I'm not saying there's no, speculation involved, but this isn't gambling. This isn't like, get a hunch, buy a bunch or whatever. This is a long-term framework where we're looking at correlation analysis, technicals, market sentiment. We're looking at all this stuff paired with what our risk is and doing the things that make the most sense. Which, obviously first we have to figure out what is our risk and, what is our true risk and how are we going to lay that off? There's a lot of different segments of the business on this call right now. We have sawmills, who obviously their risk is, downside. We have multifamily jobbers, their risk is upside. We have a lot of manufacturing accounts. We have small lumber yards, and everyone has a different profile based on what the business model that they do is. A lot of folks, float their market prices and maybe readjust it every 20 days, in which case you have risk, but it's not nearly the risk of what a sawmill or a jobber would have that's selling, 10 million feet that doesn't start for 6 months. So you got to first analyze that to come up with the right strategy. And, bottom line is really hedging is just allowing us to kind of keep a steady hand through all these crazy markets up and down. And we're looking at the long run and we're looking at the net profitability of the net position of what we're trying to do. We're not judging hedging as its own profit center where you're only looking at your P&L of your hedge account. You're looking at the total net over time through up markets and down markets over a period of a few years, because that's where the true benefits will start to show. You're going to have, from a forward pricing example, you're going to buy forward pricing sometimes, and if the market's going to go down, and you're going to be like, man, I left money on the table. There's going to be other times you're going to buy forward pricing, it's going to go up, like for example, in 2020. And we have a lot of people on this call that can attest to this, and they're saving millions of dollars. So, you got to think of it over the long run. Stay with it. The tools, I don't think I missed something. Okay. The tools are pretty straightforward. I think you guys I'm not going to go into too much detail. Forward pricing, obviously, fixed delivery, fixed price, fixed time period. Swaps is the same thing, except instead of shipping the lumber, we just do a cash settlement, which a lot of folks like using that because they still have the ability to be in the marketplace doing their own buying, but they have a financial overlay to protect them. Those are the two main things that we offer at Sherwood from a risk management perspective. If you look to the Chicago Mercantile Exchange and some of the listed contracts, obviously futures and options, they're standardized. They're on 2x4, Western Spruce random. They're traded on the CME. We can help facilitate that stuff, but most folks are going to trade those instruments through a broker. You'll have to have a broker with a membership on the exchange that can help you with that. If anyone needs direction in that regard, you can reach out to us after the call. The gentleman we use does an absolutely fantastic job for us. super smart, and I'd be happy to share his contact information with anyone. He does a great job. Okay, so we're going to talk about, and Kyle, jump in if I'm missing anything here. I'm just kind of firing away here. We got to look at a lot of considerations for our process of what we're going to do. So I'm going to get into that.
Right. I think one of the things, just to kind of add it in here, Steve, is like where to keep it simple, stupid. And that's where we look at like, where does the industry in many cases, try to do too many things as opposed to really looking at what the real risk is in the marketplace. And one of the things that we have really worked and focused on over the last really like 8 to 10 years, specifically Steve and I, is really trying to pair the fundamental analysis with the technical analysis. Steve mentioned earlier today that, in the short-term period of time to the intermediate period of time, many of us that are on this phone call do a fantastic job in analyzing the fundamentals of the marketplace and making a buying or a selling decision. But we don't have enough information to really make a long-term decision. And that's where some of the technical analysis is. And that's also allows us to understand what the momentum of any one move might be, or lack thereof might be. So the ability to use the fundamentals, even though the fundamentals of the information that you're getting, that I'm getting, that the sawmill is getting, and what have you, is very fragmented in the lumber and building material world. It still is data, and we use that paired with what we're reading on the future side, on the technical side, and then ultimately and looking at the correlation between all of the things that we are trading on a forward price basis. Remember, Steve made mention the Chicago Mercantile Exchange is using a derivative of one lumber item, 2x4, 2 and better Western Canadian SPF. But what we are doing is providing you the opportunity to go out there and hedge your risk on all the items that you buy, from 2x4 to 2x12. And when there's opportunities, we look at some sheet goods, but that's few and far between because there's only certain times of the year, certain times of the trade that there's any correlation with those. So in most cases, and if not 95+% of the cases, we're looking at 2x4 through 2x12, Western spruce, Doug fir, Eastern spruce, Southern yellow pine as the major species groups, and looking at all those items and correlating those to the 2x4, 2 and better Western Canadian spruce number, and plotting a number for you to take delivery on product for your jobs to be for some point in the future. But we don't do that just by looking at those independent of each other. We look at those in correlation to everything else that's happening around it, because what's the price direction of one item versus another is not equal in many cases. So we have to make sure that we're looking at all of those data points and putting that into consideration when pricing a project out for any one of you. But really focused on looking at these key fundamental drivers and these key technical drivers. And if you can do that with any consistency, and the other item is being very deliberate and focused on it, you can create a real solid risk management strategy. And that's something that Steve and myself have really worked hard to go out there and develop and tweak along the way, because it is there are many moving pieces that move along these things, as many of you know. Back to you, Steve.
Yeah, no, that's a good point. And things, I mean, things are evolving so rapidly, even within our space, that the reality is what's worked 3 years ago or 2 years ago or what this year or what works now, it probably won't work in the next 2 years, 3 years. So we all have to we have to look at all the tools, all the pieces of information, know how to use all the tools, because things are just changing so fast in such a hyper competitive consolidating climate for all of us, that this it's really important to understand how to do all this and to always looking to get better too, because we're no different. I mean, we have to constantly adapt just the same as everybody else. But and just backing up briefly to Kyle's point, I don't think I didn't really touch on it, is he's correct in that the contract, everyone talks about futures, right? Futures is 2x4 Western spruce. Really what we're doing for people is all species across the country in most of the bulk commodity items. So we're doing shipments and jobs in Florida all the way up to Washington. across the country, different species. So, commonly people will call me, like I had a call yesterday with one of my trust accounts, and he goes, "Hey, what are futures doing on 2x4 MSR?" And obviously there are no futures on 2x4 MSR. What there is a over-the-counter, product that Sherwood Lumber's developed to be able to facilitate, in a sense, futures on MSR, but you can't call the CME and trade that. So that's something to keep in mind too. It's very different. I think certainly a lot of folks have hedging accounts. They trade the board, they trade spruce futures, and they should, but it's really important to understand that the one doesn't necessarily always move with the other. And that's where the fundamental technical analysis Kyle's talking about really comes into play. There's just a lot of moving parts. Okay, so we've decided we're going to do risk management, and obviously we want it to work. So there's just some stuff you want to consider to get the most out of it. Kyle just mentioned understanding the technicals and the fundamentals and how they work together is very important. This whole thing is part science and part art. Things are always evolving, and no one really knows the answer, and no one hits it right every time either. But it's sort of like, for those of you guys that, have been poker players, it's sort of like, knowing when the odds are in your favor and you want to, bet a bigger stack than when you want to just kind of, limp along because you just don't really have a great hand. So it's sort of the same, we're in an uncertain world and we don't know what's going to happen, but we're going to wait to do things until we feel that the perceived odds are in our favor, to put these sorts of trades on. That's where using the fundamentals, technicals, and all that sort of thing really plays in to help kind of figure out kind of a risk reward analysis on all these sorts of trades.
Yeah, Steve, just to add, I think that in itself is the number one thing that we can do in talking to our clients throughout the time, is on them understanding what that fundamental and technical picture is, and then us helping them try to match that with the goal that they're trying to go out there and meet. So just a quick overview, what's the real basis of the fundamentals is determining if the said asset is undervalued versus overvalued relative to the market, and then looking at it relative to the hedge and looking at that. And then on the technical side, what are we trying to determine there? We're really trying to say, where are we in the cycle and what possibly could be the next move? And then putting a risk management strategy and plan around that to go out there and reach that goal of what the client is looking for.
Yep. Well said. And then the second one is something I'm probably preaching to the choir a little bit, but I think it's just important. It's a really important concept when we jump from just being involved in the physical cash lumber world to getting into this world that is tied to futures. And that is that futures is a leading indicator. They move a lot different than cash a lot of times. I think the old way, a lot of the big end use guys, the big builders and whoever, they get print, they're pretty sophisticated. And when the market's falling, I'll just give an example. The market's falling, they're waiting for print to flatten and maybe start to tick up before they buy. Okay. And that's really, that's what they do, and that's kind of always worked in the past. The thing is, futures is a leading indicator. So what I often see is after those events take place, the market has, cash market is bottom, print's starting to print up, then I just get flooded with forward pricing increase. And the problem is futures are a leading indicator. Futures is bottomed a month ago and it's already way up. We've already missed a $100 move. That happens all the time. So that's where we can help. You have to buy it differently. You have to really, this isn't really about out trading the market. It's more about picking points that make sense and being comfortable at certain points in the long run of like laying off risk and locking in profit and just doing it and then moving on, because this really isn't a program that's, sole purpose is to like buy cheaper than the market. Now, if guys do it right and they execute right, they can make some smoking deals and that'll work really well to their favor. I have guys on this call that are up multiple seven figures from doing this with us. Okay. So that's a real deal. But at the end of the day, that's not really, they're really doing it just to lay off their risk and mitigate. And, so it's just futures move differently than cash. And so that's where working with us, with me, Kyle, myself, and your sales guy, we can really help with certain points. I think are, the timing is right, and sometimes it's a little bit of a leap, because usually when the timing's right is when it's the hardest to buy. But it's really important for the guys that really figure this out are the guys that really kill it, and they're pretty sharp. So So you got to look at that. And then, with any hedging, you got to look big picture, you got to look long term. There's so much fluctuation. You can't, you just have to pick, you have to, based on the technicals, you want to look at what your position is, figure out at what given points you have, what your risk exposure should be based on a lot of the technical and fundamental data, and then just execute a strategy. So you got to think big picture. You can't think trade by trade. You got to think big picture, and you got to think long term. Again, these results really, you can't measure them monthly or even quarterly, or I guess in some cases yearly, but you really need to go through 2 or 3 up and down cycles to really reap the benefit of it. And the guys that do, they keep coming. I mean, everyone that buys this from us, that does this with us, they are always in there with us, because once they see the value of it, it's really worked for them, and they're always customers because it just works. Oops, sorry. This kind of gets back to what I said before. Make sure your goals are aligned with what the programs are designed for. So hedging program is not about always buying the cheapest price. That's not what it's for. It's for strategically locking in margin and laying off risk, at the right time to reduce your overall earnings and make money. So that's what it's for. You're going to leave money on the table a lot of times. Other times you'll make a bunch, but really you got to look at it over the long run. And then the last thing is you got to align with the right people when you do this stuff. It's very different than just buying a spot market car lumber that's going to ship in 2 weeks. There's a lot of, you have inherent counterparty risk when you do this. And so do we. You have to trust us that if you buy a bunch of cars and the market's up $500 a thousand, that they're actually going to ship. And because, but there's been a lot of stories where it doesn't, and there's drama and it's a mess. With us, it will. I mean, there's always crazy things in the market, and sometimes the mill will be late a week or two, or things happen, but it's always going to ship. You're not going to have any problems. And the guys everyone that does business with us can attest to that. So you really want to align with the right people. And that goes both ways too, because we have to trust that when the market falls 300, that you're going to take it, because we hedge that, and we're losing money on futures on the backside. So anyway, it's really important. I just got off a call about a week ago with one of the main folks at one of the big national companies, and basically he expressed that several of the they did some big orders with a few vendors. It was about a month ago, I think, or maybe 2 months ago, and the guys are backing out. They're just like, sorry, price is up, we're not shipping them. And that happens all the time. So you can't do, you gotta, go with the people that are, are going to come through for you when you need it the most, which would be environments like we've just been through. Sometimes you might find some fly by night guy and it'll be $5 cheaper. That's all great until the market's up 500 and he doesn't ship it. So and there's some good players out there. Just align yourselves with the right people. That's very important.
Yeah, and I guess the biggest thing for this is to go out there and have the opportunity in a market like this where we have huge fluctuations, to be able to go and know that you're going to have product when you committed it for your customer, and you were able to lock in a margin. There's just no question about it, and you don't have to pay for it until the material arrives for the job or directly to the job. Which from a cash flow perspective, there's no inventory buildup that's required or anything like that. It can be spread out over the usage period of that was committed to, and it makes it very, very easy. And to Steve's point, he said earlier, like the guys that are doing this have figured it out. They're quoting their dealers, their contractors, their developers this way, and they are just repeating business after business after business. And yeah, they might not be hitting home runs on every single transaction, but what they aren't doing is they're not losing any money ever. They're going out there and they have a price, they're putting a margin on it, they're locking in the price, and they're moving on to the next sale, next opportunity to sell, and so forth and so forth and so forth. And they never have a situation where they're out of product, where they've lost money, or any of the things that would be detrimental to continuing to be in business. And it provides them a great opportunity to go out to do that. Now, every customer that we work with has a different risk tolerance. So some might say that they want to look at, given where we are in the price range, I only want to lock up 50% of this job, or 30% of this job, and I want to go open market with the rest and what have you, and see if I can go out there and try to lock in a bigger margin. But at least this allows them to go out there and get, have a job that's due to start in 6 months from now, 8 months from now, be able to quote a price, go and lock down the business, and then go and decide how much risk they want to take, and then ultimately go lock that in with a vendor, a portion of that, all of that, or whatever they choose to do. And it's allowed a great opportunity. I can tell you, like with last year, and Steve talked about some of the savings people had. The savings might not have been on what they were able to make on that job, but the savings were of what they possibly would have lost on that job had they not covered it in the way that they covered it. Specifically last year, when we had $700 1,000 move from peak to trough, or from trough to peak last year, and then another pullback in the the middle or latter part of the year as well. So it's been a great way for them to really flatten out the curve and allow their consistency to play through in a marketplace that created a lot of disarray for many, many different pieces.
Yeah, that's very accurate. A lot of guys, their competitor right next door was scrambling and just getting annihilated. Well, these guys are just sitting back, getting cars at 489. So it can work really well. And the other thing too, like, there's a lot of moving parts to this. So really everyone on this call is different, right? And really we work with everyone on down the chain, from sawmills to big lumber yards to regional small guys, one-off shops, multifamily, truss guys. So really what we got, you're not going to get off this call and all of a sudden like know how to hedge everything. Like this is like the introduction to having a further discussion with us, because we're going to customize and tailor the program to exactly what then your needs are, and everyone's needs on this call are totally different. So I would just want to emphasize that too. This isn't like a one size fits all kind of deal, but we can help with all the different all the different needs of what people have. So should we move on to the market a little bit, Kyle?
Yeah, let's do it.
Okay, so this I'm gonna have you handle this one here. The Great Lumber Shortage 2.0.
Yeah, so we talked a little bit about this in some of our previous webinars. The Great Lumber Shortage that we talked about in the middle part of last year. I think September was the last webinar that we did. So now I'm going to be talking about the Great Lumber Shortage 2.0, being that now we're in a new year, 2021 versus 2020. But we'll do a little bit of a review of where we were to where we are and to where we believe that we're going to go. Maybe not to the exact numbers where we're going to go, but the directions that we're going to go. So we'll talk about that. So right here, this is a chart or a slide that we shared with you back in September that talked about the Great Lumber Shortage and kind of what was next. This was September, if you remember, was the peak of the first move of the COVID rally. And a lot of talk back at that time was, what's going to happen? Are we going to revert to the mean, which is the bottom chart, or are we in the new lumber range? And I highlighted that top in that chart because we were starting to do some deep analysis and history over the last 30 or 40 years and saying, was there phenomena like this that happened during those periods of time that could possibly happen now or are happening now that would indicate that we possibly are in a new range? And I will tell you, I think not only based off of the sell-off that we had in September and October of last year to the rebound that we had in November, we definitely are in a new range, and we'll show you a little bit more of that. So Steve, you want to go to the next slide? So back then, in part of our analysis, is one of the things that I was really going back and forth with, which I've shared a lot with many of our clients that are on this call and internally to our team, was kind of assessing what the 1 year moving average is versus the 2.5 year moving average. Remember, we talked about technical analysis versus fundamental analysis, and fundamentals are what we do every single day, talking to our suppliers, talking to the secondaries, talking to our contractors and the developers, and trying to understand what really is happening inside of those supply and demand curves to understand exactly what the real intrinsic value of lumber is at that given time. Well, the technical analysis, as we talked about, they don't care about intrinsic values. What that cares about is movement and momentum and how longevity of how we're going to be in that. So in some of this technical analysis that we're looking at, we use the moving averages quite extensively to kind of to allow us to understand how large of a position we want to have on at any given time in that part of the range or small. And what I can tell you is looking back 30 years and analyzing the 1 year versus the 2.5 year moving average, what is happening now only happened 7 times before this. And in that cycle where the 1 year moved above the 2.5 year, on average, over those 7 times, the market it would average to over 24 months. So we talk about, are we in this new cycle? I believe so. Right now, based on our analysis, right now we are only in month 6 of this new cycle, and everything that happened with the sell-off in October, November, to the rebound, I should say the rebound in November to where we are in January, even the sell-off that we're currently having in futures right now, which, by the way, doesn't look like it's much of a sell-off anymore as it's rebounding today, and it has rebounded earlier this week. We are getting lots of support in that key technical points, which would only continue to solidify our theory that we're in a new range. We are in a new cycle, and we're very early in this cycle. Like I said, we're in 6 months of a cycle that typically averages over 24 months. So if you're planning on thinking that we're just going to go back to, what we dealt with in COVID was because of COVID and we're never going to go back there again, well, you already saw it back in November, and we will likely see it again. I guess, for those of you who I'll probably use, I like to ride bicycle. I'll use this analogy. When you're pedaling from the guy behind the guy in the front, it's much easier to get to your destination, right? Because you're drafting him. So because we've already been at this price range or hit these high level price points before, it's going to be much easier for it to happen a second, a third, and a fourth time. It's kind of the same concept that you said, if for your NASCAR fans out there, if I'm drafting you in Daytona or Talladega, it's much easier for me to go past you before that finish line because I've created momentum because of the path that you have led for me, and that's exactly what we're happening right now in the lumber market, and the likelihood to retest or possibly create new highs from where we are today is very apparent, and I believe very likely as we move forward with this challenged supply chain that we continue to have in the marketplace. So we'll be working through that. We'll be watching that. We have not got any indication that this cycle is petering out. In fact, all we're getting is more confirmation that it's going to continue. So that's what we've been working with our clients and helping them price accordingly and getting preparation for this second, third, and fourth quarter of 2021. Let's go to the next slide, Steve.
Hey, Kyle, before we do, we have a question from Sean.
Yeah.
Sean's wondering what technical charts are being used on this slide.
So on this slide, we're only looking at two key factors. Well, there's actually 3. We're looking at the relative strength index, the stochastics on the bottom, and the red line is the 2.5 year moving average, and the green line is the 1 year moving average. So there's 3 technical indicators on that. And you could also measure the volume too as being one, but the 3 ones that we're focused on are the moving averages and the relative strength index.
Yeah, and the key being when the lines cross, when the 1 year passes the 2.5 year, both on the upside and downside, it typically is instructive on what's to follow for a while. Which is what we're in right now, what Kyle's talking about. So
yeah, so those highlighted bars you can see are the time periods of the previous 7 times that this has happened since 1992, you can see in the upper right hand corner that we're in 6 months of the most recent cycle.
Yeah, and just a little perspective I'll add briefly too is this. So our analysis basically is saying that there's a strong likelihood we stay in this crazy environment. Now, we said earlier, I mean, we don't know, right? Things could change. No one knows. We've already said that, but you better have a risk management program in place in case this bears out to be true, which it has in the past pretty accurately. So it's just this would be an example of, like, you look at this technicals to formulate, okay, now that we know that, statistically, we probably have a better than average chance of, staying in a crazy elevated environment for a while. Like, what are we going to do to protect ourselves? And so that's where it all sort of comes home to roost. It's not that we're necessarily saying this will happen, but the likelihood of it happening is not trivial. So that'd just be some, some addition there.
Yeah, so we'll talk about some additional fundamentals of what we're looking at that will continue to support that demand and that lack of supply. And so this is the next slide where we talked about the great lumber shortage 2.0. What's next? We look at the current and future demand. This is a chart that was provided to me by Fast Markets, RSI, and one of my NALA 10 groups, and we talked about this extensively of what is currently happening in construction that's not started versus what's under construction. And then you can notice on that the purple line versus the yellow or the orangish line plots, there's a huge gap. And that gap typically is talking about what the future demand is going to look like. And because that gap is so wide with the orange line over the purple, it looks like we have substantial liquidity, or I should say business ahead of us over the next 6 to 12 months. And until those lines come together or we see them revert, we're going to likely be in this high demand cycle for the foreseeable future. So, housing demand continues to be fully recovered. The one thing that we talked about in a recent meeting that I had with couple of economists and variety of mills and so forth was specifically to why, what we're experiencing today. And I think the single biggest thing, everybody's talking about COVID. COVID wasn't the reason why the lumber market is where it is today and what have you. In all likelihood, this was going to happen, maybe not to the extremes of this pricing scenario, but we were going to be in a new cyclical wave where that 1 year moving average would be higher than the 200-day moving average, or the 2.5 year moving average, and we would be in an upward bullish cycle in lumber for a long period of time. And this was starting to happen in last year before COVID even hit, because we had an extremely low interest rate environment. We had the largest demographic component finally coming into the housing sector, which are the millennials, which that 31 to 33-year-olds have the highest demand that we've ever seen in buying a first-time home, purchasing a new home, and so forth. So that in itself was going to push us into a longer than normal cyclical up pattern. COVID and the supply disruption from it just created an accelerant to what we were trying to do. COVID is totally the accelerant. It's created this phenomena that we've never seen in lumber pricing, which, by the way, we'll probably continue to see for the foreseeable future until we, as an industry, can go and manage our risk, manage our inventory profiles in some form or fashion that would be back to pre-COVID levels. And until that happens, we'll likely be in this rinse and repeat cycle for quite some time. So we're going to continue to watch this and manage our risk appropriately and work with our clients to do the same. In addition to this, with the change in administration and continued liquidity, meaning we're going to continue to be in an ultra low interest rate environment, there is not only, we already had stimulus, but there's even more stimulus coming into the marketplace. Commodities in general, if you go look at copper, you go look at corn, you go look at any of the major commodities, specifically to building materials, metals are on fire. We are in a very, very commodity driven marketplace right now, and lumber is going to continue to get swept up in that. This infrastructure build that's going to happen over the next 2 years is going to create challenges, and what really has pushed lumber prices to where they are is the repair and remodel segment. It's not necessarily new housing starts. New housing starts, yes, are pushed to that 1.5 or higher mark right now, but the surge in repair and remodel has really taken a tremendous amount of supply out of the marketplace. And also in one of my most recent meetings as well is the change, or I should say, the addition of mass timber. Everybody's talking about, mass panelization and mass timber products and what have you. Well, Europe is now up to 100 cubic meters of mass timber demand, and the United States and Canada is over 200 million cubic meters. And that is taking essentially about 4 sawmills that were previously producing dimensional lumber or plywood off the market, meaning that's going into that commercial and that infrastructure build construction, and not going into residential anymore. So that's also a factor into the supply chain that a lot of people haven't really acknowledged or really taken a notice to. So it's definite changes, which are going to continue to make some challenges for us in the future. The other thing that we don't recognize is this continued liquidity and more money being thrown, monetary money being thrown into the system here in the United States. It's going to keep the dollar relatively weak compared to other currencies. And that is going to limit the amount of additional European product, the additional Brazilian product, the additional Chinese product. It's not to say that we won't see some of these products, or even partially more of these products here, but you're not going to see this wall of wood coming from one direction or the other. It's going to be very, very much a steady flow of product as opposed to this surge. And it's something that we'll continue to watch as well. I guess some of the headwinds that we'd say from a bearish cycle, we still don't know what commercial real estate forbearance turns into and foreclosure. We're not so sure how that's going to play out. So we will keep an eye on that. And we're still also, as an economy, not so sure, with the COVID related shutdowns, what's the total job loss is here in the United States or North America for that matter. So something that we'll also be trying to get a handle on over the next couple months or quarters once that economic data comes out. Steve, you want to go to the next slide? This is the other thing a reason I continue to believe that we're in the early stages of this cycle. Yes, we're seeing some small ticks up in interest rates, but they've been very, very marginal to say the least. And we've seen, unbelievable increases in home building products and lumber prices, right? So commodities in general, all of these things have gone up, but the discounted interest rates and what that is doing to overall affordability to the home is keeping it at historic low levels, at least as measured over the last 5 years. And back when we saw the big uptick in lumber prices in 2018, that made affordability more difficult. We're not seeing that as a phenomena yet this year. This is also another chart presented by RISI and Fast Markets. It just shows you that where we are with on a 30-year fixed mortgage and at the median home price, which the median home prices continue to go up, but mortgages are either flat to down. Our affordability for the first-time home buyer or even the second-time home buyer is still sitting at multi-year lows, so or at reasonable levels compared relative to the increase in building products and so forth. So another reason why I believe this demand part of the segment stays relatively high as we move through 2021 and beyond. Next slide, Steve. So where are we? This is a chart that I shared with our management team, shared with a few of our clients as well. You can see that it was time-stamped on January the 5th. And we were talking about January contract having eight trading days left. I think it has 1 trading day left. So this was 7 days ago. And our read on the market at the time was that with the March contract currently $220 below the January contract, this is what could happen to the market, or I felt at that time based on what was happening. And I still believe it holds true, and that's why we're showing it to you. That it's going to, one of two things could happen. Number one, the discount is too large. The seasonal strength is too good. The fundamental strength overrides, and mills come to the market before building more of an order file, and the market finds support at the 100-day moving average, which is the red curve, and bouncing quickly off of that 640 and racing back to 750. Just for number two, the technical pattern is too strong. Similar to what we experienced back in October, or I should say September and October of last year, and price discovery continues. The March contract continues to sell off and moves towards the green line, which is the 200-day moving average, or 525. I just want to point out that both of these scenarios are extremely bullish for lumber, even though that you're seeing a peak again of 850 and a retracement to 525 and on the second option versus 850 peak to a 640 bottom in the first one. But both of them are very, very bullish from a long-term perspective. One, because we've already been to those high levels before, it gets easier to get back to them on every bounce that you have. And what it's saying is that the market is recognizing that there's value at these key technical spots, and is supporting the market in each of those directions. So what I can tell you is the market seems to be reacting more like number one, whereas it retraced to that 100-day moving average and has now bounced. The January contract is up about $55 today, back up to 855 and or sorry, 865, and the March contract has jumped up in the last 4 days, is now bottomed right around $635 and now is back up to 680. That's telling us that this thing is, has a lot of more support than it had the last cycle, or I should say the last sell-off. And being that we're going into the highest consumption period of the year, it likely will continue that trend as we move forward over the next few months. So just be aware of it. It doesn't mean that we can't go down there and retest that 200-day moving average, but it doesn't feel like we're going to here over the next 5 to 10 days at least. But either way, even if we do, there's major buying support down there, and it would continue this upward momentum. And in all likelihood, we would see a race back up to 700 plus very, very, very quickly. So that's our read on the market. I guess, Todd, are there any other questions that are out there that we could possibly answer?
I just pulled the audience, Kyle. So I said same thing that you just asked. I said a lot of good information here. Before we move on, any questions? I know that we'll probably have to catch up if there are, but I will let you know if we get any, okay?
Great, thank you. So, Steve, anything to add on stuff that we just mentioned?
No, I think that, I think that we all understand that we're just in this new environment for a while that's going to, essentially be one of hyper volatility, both up and down. And I think it just underscores really just from a conception, from a big picture standpoint is just, don't be afraid to use these tools. The guys that are using them are the ones that are, really outperforming. We can certainly help with where and when and how. But it's just so competitive right now and so challenging that like any little, competitive advantage that you can do, that all adds up to big dollars in the long run. And so I just think we're in this for a while. It's going to be crazy. It's going to be boom bust and, rinse and repeat. And we just have to figure out how to navigate in that environment. It doesn't look like there's any real, it doesn't look like the inventory pipeline that, is when you're at $1,000 lumber is really ever going to, get flush to where it should be, at least for a while, which will, mean that the industry is perpetually underbought, meaning when you do have these, big pullbacks, there's an enormous need to buy. And so it's just like last time, you pull back pretty hard And then once it's go time, it's like, boom, the thing's up $300 1,000, you know, and if you're not like in there in the first few days, you're just right back to where you started, you know? So, I think it's just going to stay crazy and just, you know, so we just have to understand all this stuff. Um, you know, understand that we could continue to be in this kind of cycle for a while. You know, and just figure out, you know, looking at your risk management profile and what you need to do of like, hey, what am I going to, you know, things have changed, right? So like, what am I going to do to navigate through this stuff? So that's just my, you know, that'd be my 2 cents, I guess.
So Steve, like if you had to, you know, ask like, what would be the next steps that you would recommend to anybody out there that's, you know, has some jobs that they are quoting, let's say for April or beyond, you know, what opportunities might exist for them today to, from a forward pricing perspective?
Well, certainly, you know, right now, you know, you are in an environment with, you know, futures discounts going forward. The term structure of futures means, you know, obviously there's a futures contract for every other month going forward. And right now, going out several months, you know, you're at pretty decent discounts to the current cash market. So there's a good opportunity for folks that, you know, we understand that there's going to be a lot of demand. We don't want to be frantically chasing it when the thing, you know, is all going crazy. So I think the key is just to like dust this stuff off and figure out, okay, you know, at what levels am I good to go to like lock some of this in? If we get to, you know, if we get to 900 on studs, do I want to buy 30%? You know, if we get to, if it's at 1,000, do I want to buy? I mean, you know, just figure in these games, like these rationalized, figure out this stuff of what you want to do. Talk to your Sherwood guy. I mean, Kyle and I are available to talk to anyone on the call. And, you know, but also, you know, whoever the rep you're dealing with is, can also filter that information down to us. So however you want to do it, but there is good opportunity right now. The other thing I think we should point out, is that the historical relationships between items are absolutely, they're completely blown up to what you would normally experience in a standard like pre-COVID market. So in other words, people are looking at the board and, you know, futures are 300 under cash, let's say on 2x4 WSPF. Well, the thing is that doesn't translate anymore to $300 under on a lot of these other items, because the reality is these relationships are not, you know, tracking what they normally would for quite a long time. So just, people need to kind of understand that that game is evolving too, that the historical norms are changing there. And so you might not be able to get 300 under on everything just because the board's 300 under, you know, on 2x4 random spruce, you know. So, and that's going to vary item by item. There'll be times when you will. It's evolving, it's moving quick, but I think there's great opportunity. I mean, I think, you know, right in here really is presenting an opportunity to lock in some. I'm not suggesting I, you know, cover 100% of my needs like right now, because we are nominally still at elevated levels, but knowing the volatility potential, you know, that exists for when we do hit a bottom, it's going to be crazy. And then it's going to be up $200 and it's going to be gone. So just like get your stick on the ice and figure out what you want to do. We can help. But it's a good opportunity right now. I mean, you know, there are times when I would tell you, man, it's really not that great. Like I wouldn't do that much right now. You know, it doesn't make a lot of sense, but I think right now it makes sense to do some for sure.
Yeah, I think just to, you know, I think we would have definitely said at the end of between Christmas and New Year's, the market was kind of hitting, you know, retesting those highs of the market. And we were quoting some things for our customers. And I was just like, oh, let's just see what happens after the new year. I think there might be a better opportunity for us. The basis wasn't really there, and we didn't really have a good picture of what was happening in the fundamentals of the market. And remember what we said, those two things that you need to do in order to create, you know, once you know what your goal is, you have to know what those fundamentals are. You have to know what the technical side is doing. And when you're ready and you know that, then you can put a plan in place and go out there and execute it on. And that's what we talked to many of our clients through that period of time. So, but that being said, I mean, I think your answer to the question was awesome. Like the key is knowing what you have, what risk that you have over the next 6 or 8 months, putting that out on the table, talking to the people that you trust. Hopefully it's us at Sherwood Lumber, but maybe it's somebody else, what have you. But talking to the people you trust and say, hey, I have this. These are the orders. I might have orders against it. I might not have orders on it, or I have this opportunity to get business on it. How can you help me go and capture this business? How can you go out and help me cover this business? How can we help put this together to ultimately create a win for both of us and take that risk off the table? Because we don't know what the peak is going to be. We don't know what the trough is going to be, but we do know there's going to be lots of volatility, and I want to make sure that I have product when I've made that commitment for. So and have it at a price, hopefully, that's going to allow me to make a margin. And I think that's something we can. I know that's something we can definitely do. We just have to start that dialogue and get that level of communication happening today. So hopefully that spurs some thoughts and hopefully some initial conversation. And that was our goal in having this presentation for you guys, and then get you to think a little bit differently than just going and buying a big inventory and sitting on it and hoping that that's going to be enough to cover you for 30, 60, 90 days. But when you can really start to say, okay, I have an opportunity to carry a 150-day inventory because this customer, well, not really an inventory, but I have an opportunity to buy 150 days out without carrying an inventory because I have this vendor that will do that for me. So great. Steve, anything else that I might have missed?
No. I mean, we can help with all that timing. And I was just going to add one more point, then I'll be quiet. And I think, and this gets back into looking at futures versus cash is different also. Like the other thing is, like right now, cash is starting to get a little bit spongy, so a lot of people's your instinct is to pull back and not buy anything. But the thing is, futures is it's a leading indicator, right? It's already way under. So like the price is already there. You know what I'm saying? Like, so you got to talk to us. We can help guide you through that process. As the two things aren't necessarily moving. It might be a terrible idea to buy cash right now, but it might be an awesome thing to do futures. So just keep that in mind. But anyway, we appreciate everyone's time. Kyle and myself, we have our contact info up here. Feel free to reach out. We really appreciate it. Obviously, a lot of guys on the call have supported us for a real long time. And then there's some other guys that we'd love to do some stuff with. So anyway, if there's any questions, reach out. We're here to help.
So Steve, Kyle, I've received 2 IMs and 1 chat. So just a couple of things for you, if we could. Bethany said that she attended the last presentation and there was a conversation. She received lumber numbers. I guess for the overall group, did you want to take a moment to discuss lumber numbers, and then at a different level, just address how one could get their hands on it?
Yeah, look, we do produce a document every single week. It's a proprietary system information that we use every day, really, in regard to not just inventory management, but also from forward pricing management and overall risk management. It's called Lumber Numbers. We keep that internally, and we do share that with clients on the outside that we're currently doing business with. I think in the last webinar, we offered it a week or a temporary subscription to it for a period of time for attending the webinar. I think I'll talk to Michael Goodman. I think we can do that the same for everybody that signed up for this webinar. So you'll be seeing Lumber Numbers week number 1 and week number 2 at a minimum coming into your email inbox here shortly. But yeah, Lumber Numbers, just a quick overview, is a non-biased numerical analysis of the relative relationship of all forest products to their seasonal indicators, to the hedge relative to the hedge, which is to the CME or 2x4 2 and better Western Canadian spruce, relative to themselves and relative to their own market segment. And then we use all of that fundamental analysis to go out there and make a decision if that product is overvalued, undervalued, and what that movement it could be over a certain period of time. So we look at the past and project the future with it, and it is ultimately helps us make a lot of better decisions, and specifically in our inventory management side, and allowing us to carry the proper amount of inventory on items that we might have more opportunity to make a margin versus ones that we might have more risk associated with them. So we'll be happy to provide a trial subscription or a few weeks of what that does. But what I will tell you is, in looking at it this year versus last year and how it performed relative to last year's market, within a week or two, it was providing us confirmation of everything that was happening in the marketplace. And it's like, it doesn't have emotion, it doesn't have feelings, it's out there, it's just reading what's happening, it's looking at the numbers and it's projecting the next number based off of a formula that we have built in our system. So it's really, really cool. And I recommend if you guys aren't using it or would like to use it, Steve and I can provide quite frankly, a little bit of an education, a webinar of how that thing works and maybe how it might help you in what you're doing on every single day. Back to you, Todd. Any other questions, or Steve, anything to add?
We have two more, and thank you. Yeah, I think we've gotten a couple customers giving us some really great feedback on lumber numbers, and I know if they want to learn more, they can probably go to sherwoodlumber.com too, just to look some stuff on their own if they want to get a little bit of a flair for it. I have a question here from Mike. He's asking if I have an understanding of my inventory needs, but I don't have necessarily a large job to cover. Is forward pricing something I can do for my inventory?
Steve, you want to take that one?
Yeah, I mean, you certainly could. You certainly could, yes, and a lot of guys do. You know, I would. There's a lot of things you'd want to look at. I mean, you'd want to look at how you're pricing it to your, like, are you able to float your prices with the market? You know, in terms of where you're selling it at. In which case, you might not have as you might not need to buy a whole bunch forward pricing because you're essentially insulated from risk because you can move up with the market. But in other cases, a lot of guys use it as a like an inventory, like a dip your toe in the pool kind of price. Like, in other words, you know you're going to have 10 million feet to buy. You think based on a lot of the technicals and things like that, that it's, hey, this is probably a good time to, you know, layer in 25% on a forward price. You know, so absolutely, yes, you guys do it, and we can help with that.
Okay, our last question comes to us from Sean. He asked if he could just ask the question, so I'm going to ask him to come off mute. Sean,
Hey.
over to you.
All right. I appreciate y'all putting this on, first of all. And my question has to do with the fundamental side of this. I don't know if you addressed this part, but I'm wondering about, you know, the timbers, the different species of timbers that, you know, we use for lumber. You know, we had the forest fires in the West, and then the beetle kill is pretty much done in Canada. How much would that affect, you know, a fundamental analysis?
So that's a big part of it, understanding what the supply is going to be and how quickly supply can be ramped up in order to meet the demand. That's something that we use quite substantially. The challenge that I have, or I think the industry has, is much of the fundamental data is so delayed, and I think that's what creates some level of uncertainty for a lack of better terms. But those production numbers take time to gather because we have a very fragmented industry. But that being said, knowing what has happened in the recent past and in the Pacific Northwest, most notably with forest fires and such, and the lack of timber that would be available, that is factored into our analysis quite substantially. So, but the firm data that we're using, you know, we reach out to FEA, RISI, and what have you to kind of help us create a more longer term, or I should say, you know, a 2-year forecast. But we're using, you know, more of the most recent information that we can gather from the sawmill output, sawmill inventories, from our relationships that we have built through the many years of buying and selling those products.
So Kyle, Sean, does that answer your question? I'll assume
Yes, it does. Thank you.
Okay, great. So Kyle, I have 2 more questions that have come up since then. The first comes to us from Phil. Phil's asking, how can I use futures to buy panels, both OSB and plywood?
You can't. I don't have that's the quick and easy one. You can't. You can use it as a pure speculation. And if you feel like you're at the low end of the range and you want to go out there, but there is no direct correlation between lumber the 2x4 2 and better Western Canadian spruce, and 7/16 4x8 4x9 OSB or half-inch CDX pine or fir. Unfortunately.
So,
Yeah,
so Kyle, if I can go one level deeper, Gustavo asked to maybe elaborate a little further. His question is, can you ask Kyle or another Sherwood expert on panels just to add more on the Phil Hawking question about Brazilian plywood prices? We have seen here a very crazy situation on prices. Is there a limit?
Look, if any person wants to know if there's a limit on where price can go, look at the June oil contract in 2020 and what that did, and during COVID and what have you. If you remember, it went to negative number. Like, how can somebody be paying me to take this commodity? Well, there was way too much supply sitting on tankers offshore the United States and China with no place to put the oil. And that's why they were trying to give it away so they could offload those ships and then move them to go get oil somewhere else. That is creating an amazing thing. So to answer your question, there's absolutely no limits to what price a commodity can go to on the upside or the downside. And why is that? Because it's a commodity. There's limited supply to meet whatever the demand requires at that given time. Why did lumber prices go to 135 Western Canadian mill in 2008? We'd all love that. It'd be so easy to buy lumber if we could buy at 135 Western Canadian mill. Well, they went there because we had a global financial collapse, and we went from 2 million housing starts to 400,000 housing starts. We had 6 months of supply of lumber trying to go and fill a marketplace that was only doing about 30% of the demand or home building that it was doing 18 months prior. So it takes time and its cycles and how that thing goes. What we're dealing with right now is the same phenomena, is that we have such an undersupplied market that is trying to feed heavy demand. And that's why prices are doing what they're doing. And we have no historical relationship of or history of being at these prices. So pegging value is very difficult. And that's why you saw what happened in September and October of last year when we peaked at 900 Western Canadian mill, and the futures contract actually hit $1,000 a thousand in the September contract, to only sell off down to 450 by the time the November contract expired. So because nobody knew what to do, and everybody stopped and did that. But what happened is they stopped, and then they were still very busy, and lumber was shipping out of their yards, and they had to go replace. And as soon as everybody decided to replace, they were trying to pick off what little availability there was out there. And that's why we rerouted back to the highs so quickly. So that's what markets do. It's really focused on that supply and demand curve. And lumber is a very difficult one to peg because there is the fragmented supply chain that's around not just North America, but the whole world.
So Kyle, we have another question from Leonard. Leonard asks, is there forward pricing available for Southern Yellow Pine, and what's your feel on the correlation between pine and spruce?
We do forward pricing on Southern Yellow Pine. Steve, you can go into a little bit more further.
Yeah. The answer is yes. It's a very large part of our book. Oftentimes up to half. As with everything else, a lot of the off-species correlations are, historically kind of blown out from what they have traditionally been. So the correlations are definitely different. Right now, on most pine, most like 2-inch commodity pine level, numbers where we are quoting, well under the current market for extended shipment on it. But yes, we could certainly talk about the specifics and where you're going and all that kind of stuff. But yeah, it's a big part of our business. We do tons of it.
Okay. I hope that answers your question, Leonard. I don't see any other questions on the chat right now, guys. So just a couple of comments, and I think we'll let everybody go. First and foremost, Kyle, Steve, can't thank you enough. I hope I speak for the group when I say this is just really valuable information. I leave hoping that our customers and our vendors on this call take the time to reach out to their local person or the names and contacts on this last screen to really see how they can either maximize their profits or minimize their risks or both. And I think that's our hope for today. For those of you who attended, we really appreciate you taking the time. Sherwood hosts these virtual aggregation events about once a month on varying topics. If you're somebody in the Northeast and interested in Everlast composite siding, our next aggregation event will be early February. I believe February 3rd. You'll see some invites for that. And with that, we thank everybody for joining. We hope you have a great day. We hope you make a lot of money in 2021, and we hope we can help you do that. Have a great day, everybody.
Thank you. This meeting has now ended.